Welcome, professionals. Today we are exploring a critical transformation in corporate finance, the Treasury maturity model. We will trace the journey of corporate treasury from a basic, reactive cost center to a dynamic, strategic value creator. Let's dive in and elevate your understanding. Let's begin with the what. The Treasury maturity model defines the evolutionary journey of a corporate treasury department. Historically, Treasury was just a mechanical payment processing unit. Today, it is a strategic necessity. The basics of this model encompass four distinct stages: transactional, process-efficient, value-enhancing, and strategic. Why does this evolution matter? The global financial crisis and recent market volatilities proved that companies can no longer rely solely on external liquidity. They must mobilize internal funds effectively. How does a company climb this curve? By automating the mundane, centralizing scattered operations, and shifting the focus to high-level risk management. In our deep dive, recognize that this shift alters Treasury's DNA from a reactive cost center into a proactive value creator. Take a look at this progression timeline. On the far left, we start at the transactional stage, characterized by manual, decentralized efforts. Moving right, we hit process efficient, where standardization begins. Next is value enhancing, where the Treasury starts adding tangible bottom-line value. Finally, on the far right, we reach the pinnacle, strategic treasury. Every node represents a massive leap in technological adoption and strategic alignment with the CFO's vision. Let's break down the first two stages. What is a transactional treasury? It is a basic execution function, primarily focused on making sure the bills get paid and cash is recorded. The basics here involve heavy reliance on disjointed spreadsheets and decentralized local teams. Why must a company escape this stage? Because fragmented, manual operations are a breeding ground for operational risk, fraud, and high banking fees. How do we evolve to stage 2, the process-efficient treasury? We standardize policies, centralize visibility, and implement automated reconciliations. When does this happen? Usually when a growing company realizes its legacy processes are choking its agility. As a deep dive, the goal of the process-efficient stage is to achieve excellence in execution, ensuring that operational workflows are streamlined across the entire enterprise. This diagram illustrates the forces driving a treasury from stage 1 to stage 2. We have decentralized silos, manual spreadsheets, and high error rates funneling into the central node, process efficiency. By applying standardization, automation, and control, we transform these pain points into a streamlined engine. Once this optimized state is achieved, it leads directly to the decision diamond at the bottom. The treasury is now ready to begin true value creation. Moving to stage 3, we encounter the value-enhancing treasury. What does this mean? It is a treasury that adds quantifiable, hard dollar value to the balance sheet, maximizing financial efficiency. The basics shift away from just paying bills to aggressively managing liquidity and mitigating risks. Why is this critical? Because utilizing your own internal cash through cash pooling is far cheaper than external borrowing, and hedging FX protects your profit margins. How is this practically achieved? By establishing regional or global treasury centers that act as an in-house bank, lending to and borrowing from subsidiaries. For our deep dive, consider multilateral netting. Instead of 50 subsidiaries paying each other cross-border and incurring massive banking fees, the system offsets these flows so only a single net payment is made. This is pure value creation. Here we see the architecture of a value-enhancing treasury operating as an in-house bank. Subsidiary B on the left has surplus cash, which it deposits centrally. The Global Treasury Center then lends this exact cash to Subsidiary A on the right, which has a deficit. The brilliance here is that the Global Treasury only goes to the global banks at the bottom for net hedging or net debt, completely bypassing the bank's bid-ask spread for internal funding needs. Welcome to Stage 4, the Strategic Treasury. What is this ultimate state? It is a treasury that actively engages in the highest levels of corporate decision-making, directly influencing M&A, new market expansions, and strategic pricing. The basics involve the treasurer operating as a co-pilot to the CFO, providing foresight rather than hindsight. Why? Because in a volatile world, enterprise agility demands real-time insights into capital allocation to maximize shareholder value. How does this work? By leveraging predictive analytics to continuously optimize the firm's cost of capital and deploying advanced supply chain financing. In our deep dive, A strategic treasury doesn't just sit in the back office, it steps into the front lines, advising procurement on vendor payment terms and sales on credit terms, dynamically optimizing the entire cash conversion cycle. This diagram showcases the inputs and the ultimate output of the strategic treasury. Predictive analytics, capital optimization, and M&A advisory all feed directly into the core strategic treasury node. The result: the function acts as a powerful catalyst, driving a direct line to the final outcome on the right, maximized enterprise value. It illustrates perfectly how Treasury transcends its operational roots. To climb the maturity model, we must discuss the technological enabler. What is it? It's the digital backbone APIs and generative AI. The basics require a harsh reality check. Currently, 74% of treasuries still rely heavily on Excel spreadsheets. We must transition to cloud-native software-as-a-service treasury management systems. Why? Because manual data entry kills strategic agility. You cannot predict the future if you are manually reconciling the past. How is this solved? Through APIs that connect directly to global banks for real-time data and GenAI for predictive cash forecasting. Look at our sample code concept, a simple JSON API payload sent from the ERP directly to the bank. This enables straight-through processing, bypassing human intervention entirely. Our deep dive reveals GenAI's true power, reading unstructured PDF contracts and automatically extracting FX exposures into the TMS. Let's walk through this automated sequence diagram representing straight-through processing. First, the corporate ERP pushes approved invoice data to the cloud TMS. Second, the TMS, acting autonomously, fires an API post request directly to the global bank. Third, the bank processes this in milliseconds and returns an instant confirmation. Fourth, the TMS automatically updates the ERP to reconcile the ledger. It is seamless, secure, and entirely touchless. As Treasury matures, so too must its measuring stick. What does this entail? Redefining our key performance metrics, or KPIs. The basics require shifting away from purely process-based metrics like how fast a payment was made to financial performance-based metrics. Why make this change? If you claim to be a value creator, you must objectively prove your impact on the firm's bottom line. How do we measure this? By tracking reductions in the overall cost of capital, improvements in operating cash flow, and the precise effectiveness of your hedging programs. When should this happen? The moment you step into the value-enhancing stage. In our deep dive, a mature treasury doesn't boast about processing 10,000 wire transfers. It boasts about optimizing the yield on strategic cash reserves and improving the enterprise's debt service coverage ratios. This flow visually demonstrates the KPI paradigm shift. We start at the top with legacy KPIs, which focus merely on volume and speed. Through the maturity shift, we hit the strategic KPIs node. This branches out into the metrics that truly matter to the board: cost of capital reduction, aggressive working capital optimization, and precise hedge effectiveness. These are the dials that steer the financial health of the enterprise. Let's apply this to a real-time, highly important use case: mergers and acquisitions treasury integration. Imagine your multinational acquires a competitor. The problem: the acquired company is stuck in stage 1 decentralized, with trapped cash, unknown FX risks, and 200 redundant bank accounts. How does a stage 4 strategic treasury handle this? They immediately deploy an integration management plan. Execution is swift. They rationalize the global bank accounts, centralize the scattered liquidity into a master pool, and gain instant visibility over all working capital. The real-world result: by simply streamlining these accounts and moving the acquired entity up the maturity curve, the Treasury saves over $500,000 annually in banking fees alone, while simultaneously using the newly discovered trapped cash to pay down the acquisition debt. Follow this M&A integration lifecycle. On the left, we inherit the acquired entity, stuck in stage 1. We immediately apply account rationalization, cutting away the dead weight. This flows into centralized cash pooling, which serves as the key to unlocking trapped cash. Finally, that newly liberated liquidity flows to the right, directly allowing the enterprise to pay down M&A debt, proving Treasury's strategic worth. In conclusion, the corporate Treasury function has undergone a monumental shift. We have traced its journey from a decentralized, reactive payment processor into a highly automated, strategic control tower. We've seen how advancing through the transactional, process-efficient, and value-enhancing stages ultimately unlocks the strategic treasury. Reaching this pinnacle requires modern platforms like cloud and APIs, predictive intelligence through AI, and, most importantly, hybrid human talent that understands both finance and technology. Your next steps are to benchmark your current operations against this model, identify your technological gaps, and relentlessly pursue value creation. Thank you for joining me in this masterclass. I invite all learners to like this video, subscribe to our channel, and visit quicktechie.com for premium certification prep, including Q&A banks, full ebooks, audiobooks, full-length training, and interview guides. Our final diagram acts as your personal roadmap. You must assess your current stage, then aggressively implement technology like APIs and AI. Simultaneously, you must upskill talent to handle these new tools. When technology and talent converge, you achieve the ultimate goal at the bottom, becoming a true strategic value creator. Thank you for watching, and see you next time.